On today's episode, I'm going to take a look at 6 stocks that I feel are going to do amazing in my portfolio. I've actually purchased them this week, and I think you guys should probably add them to your watch list. And by me adding them to my portfolio really shows that I believe these are stocks that are going to give me better results than the overall market. So today's episode is going to be broken down into the following. First, I'm going to take a quick introduction of the stock, look at their then I'm going to do a revenue breakdown, see where their money is coming from. Next, I want to take a quick look at their future growth and their balance sheet just to get a little fundamental analysis going on there. Next, I want to take a look at what I like about the company and discuss what I believe are some of the risks by investing in these stocks. Like always, if you are new to my channel, if you're a long-term investor, if you'd like to learn about growth stocks, make sure to hit that subscribe button. To all my returning viewers, thank you so much. Like always, if you want to get in contact with me, YouTube comments, Twitter, you can find me on Twitch live streaming, on my Discord channel, which is free to anybody that wants to join, and also at josenaharo.com. But remember, everything I say here is just my opinions. None of this should be taken as advice, as I am by no means a professional. So make sure to talk to a financial advisor before making any financial decisions. Now that we got that out the way, let's get started with today's episode. And actually, before we get started, on my description, I've actually put a great playlist for people that want to learn about stocks, especially if you want to know how I find my growth stocks and how I get to them before their prices jump dramatically. So you guys can check it out on the description. I have different videos there for intro to even experienced investors. And before we start, if you guys ever want to see what stocks I buy the day I buy them, just a few minutes after I purchase them, check out my Discord channel, which is free to anybody that wants to join. So like I mentioned, today's episode, we are going to take a look at 6 stocks that I purchased today. If you're new to the channel, make sure to hit that subscribe button. To all my returning viewers, hit that thumbs up. It helps the small channel out so much. Also, let me know in the comments, what did you guys purchase this week? It's always great to share with the community and help out everybody else, and maybe just give some ideas of what you might have purchased. Also, if you're new to investing or want to get a free stock, click my link on that Webull. I have it on my comments and on my description. If you click it and you sign up and you deposit $100, we both get a free stock. So make sure to check that out. Free stock is always great. It's free money. All right, so the first stock I bought is Tencent, and this is ticker TCEHY. Unfortunately, for some of you guys, you might not be able to find this in certain brokers because it is over the counter. So let's take a look at Techie, is what I'm calling it, year to date. And for all my podcast listeners, this is ticker TCEHY. Year to date, this company has returned about 37% to investors. It's been doing amazing. It's been doing amazing compared to the overall market. So let's take a look at what Tencent does. So let's take a look at Tencent's revenue mix for the second quarter. It's pretty much broken down into 4 sectors, and they're all kind of evenly spread. First, we have fintech and business services. This is about 26% of the business. Then we have social networks, which is about 23% of the business. Online games, which is 34% of the business. And we have online advertising, which is about 16% of the business. So we can see it's pretty distributed among different companies. And Tencent is pretty much one of the best ways I can explain it. It's more like a Berkshire Hathaway's type of company. It's a Chinese holdings, and they own a lot of great companies. For example, in the gaming industry, they own the creators of League of Legends. Which is Riot Games. They have 84% stake in Supercell, which owns Clash of Clans. 80% of New Zealand's Grinding Gear Games, which owns Path of Exiles. They own 40% of Epic Games, 14.5% of Glu Mobile. And let me zoom in so you guys can see. They also own 14.5% of Glu Mobile, 11.5% of Bluehole, and they own 5% stake in Activision, Ubisoft, and Paradox, all which are really big games. Reasons for them owning Activision owning 5% stake of Activision is one of the major reasons why. For example, Call of Duty is being pushed onto China, and it's going to be one of those first type of games to enter that market. And then in the entertainment, they own a few percentage of, or for example, Tencent Music. But they own a few percentage of Spotify. They also own Huya and Doju, which are live streaming platforms in China. All right, so now let's take a look at the future growth of Tencent. One thing we can see is Tencent in the past years has been profitable. It continues to be profitable, and those earnings are expected to increase as revenues continue to increase. The company for the next 3 years is expected to grow its revenue 17.2% annually on average for the next 3 years. And that's pretty strong, right? Many people consider a strong grower something, a growth company over 15%. We can see that definitely happening here. And they're also expected to grow their earnings. Revenue is expected to grow a lot faster than the industry and the market. Next, let's take a look at their balance sheet. Right now, Tencent has about $260 billion of cash and short-term investments, and they have about $273 billion in debt. This to me is actually a very, very strong balance sheet because this is a company that's very profitable right now. So to me, for them to even have a almost one-to-one cash to debt ratio is pretty impressive, because if you have money coming in, it's okay to be somewhat leveraged, right? And we can see their leverage is not that bad. So now let me talk about what I like about the company. My favorite things about Tencent right now is their strong ownership in video game systems. They own, like we saw, the types of games that they own in the companies. Epic Games, like I mentioned. They own stake in Ubisoft and Activision. They own Riot League of Legends. They also own certain stakes in Sea, which is ticker SE, and is another company I'm very, very bullish on. So these are some of the reasons, and I believe the overall gaming industry is so undervalued to investors right now that this is where I see that huge potential growth. What are some risks that I might not like about Sea, or what some investors might be worrying about? Is the first thing is this is a Chinese company. So obviously a lot of American investors, or just North American investors, are a little bit wary about these. We have, like, for example, international trade risk. We have exchange risk. There's so many risks that come from owning a Chinese stock that is something one should keep in mind of. And also tensions with other nations. If, for example, some apps get shut down here in the United States, it could create some form of effect at it. But most of the monies coming from Tencent do come from overseas. So even that form of tension, to me, it's not that big of a deal. At the end of the day, I control this risk by only having X percentage of my portfolio in international companies. And Tencent is actually a tier 1 stock in my portfolio. Tier 1s are my highest conviction stocks. I have tier 1, tier 2, and tier 3. Tencent is a tier 1, and it's remaining there. So I'm happy to add this to my portfolio this week. The second stock we're going to take a look at is Microsoft. This is ticker MSFT. Right now, year to date, Microsoft has returned about 28.3% to investors. This is a huge company, one of the few trillion-dollar market caps that we have out right now. If we take a look at Microsoft's revenue breakdown, they make revenue in 3 segments: productivity and business process. This is pretty much like your Office 365 at work, your Skype, any business products that they have. Then they have their intelligent cloud. This makes up $13.4 billion. Productivity made up 11.8, and intelligent cloud, this is their Azure network, their infrastructure in the clouding market. One I am very, very bullish on. This is up 17% compared to the same time last year in their most recent quarter. And next we have more personal computing. Here in more personal computing, we have like the laptops, the Surfaces. We have the revenue coming from Xbox and the gaming system. So we can now, and that comes with $12.9 billion. So their 3 segments are pretty much broken down into 3 products, and 2 of those segments are ones I'm really bullish on. The ones I'm very bullish on are intelligent cloud and more personal computing. The productivity and business process is also very strong, but it's not one of my driving forces. If we take a look at Microsoft's revenue forecast, is expected to be 9.5% annually for the next 3 years. For a big company, this to me is a huge amount. I mean, compared to Tencent, which was closer to 17%, obviously we can see the revenue growth for Microsoft is a lot lower. One thing about Microsoft is this has been a cash cow machine in the past 10-15 years, and we can see their earnings and revenue are still continue to increase. If we take a look at this balance sheet, this is Microsoft. Microsoft has one of my favorite balance sheets. I think Google is probably my favorite one, but they have $136 billion of cash and short-term investments, and they have $63.3 billion of debt. So they have over doubled their debt in cash, which is amazing. So companies with this amount of cash we're going to see that they're going to continue to do great acquisitions. They just recently did an acquisition to buy a gaming studio and overall increase their gaming side. So let's take a look at why I like Microsoft. Two reasons. I am very bullish in the clouding market and I am very bullish in the gaming market. Microsoft right now with releasing the new Xbox console system, with releasing the new subscription service for games, which is their Xbox Ultimate Pass. I think that is something that's going to do amazing for the company, and their strength in Azure's clouding market, which we're still seeing huge growth on. I believe these are my major reasons for investing in this company. What are some risks that I see right now? One of the major risks at Microsoft right now is the clouding market is right now driving really strong, but it could in the upcoming years begin to slow down a bit, right? We don't know how much more of this market all these companies can go in. Another thing is they have a lot of big competition in that market of the clouding. We have Google Cloud, we have Amazon AWS, we have Alibaba Cloud, we have IBM Cloud. A lot of big players are in that clouding market. Azure right now, Microsoft is number 2, only being topped by Amazon. So that's one of my biggest risks right now. The other risk, which is not really a risk I want to say, but it's not a growth company compared to all the other ones that I take a look at. But with Microsoft, it's more of a safer bet. There's always risk with investing, but it's one that has somewhat of growth still, and it also gives me somewhat of a stability in my portfolio as well. Microsoft, for those that don't know, is also a tier 1 stock in my portfolio. This is one with highest conviction. The reason it made it there was because of the gaming and the clouding market. Next, the third company I bought was Autodesk. This is ticker ADSK, and actually I think Microsoft and Autodesk in the past month have been ones that I purchased more than once in the past month. So these are two that I feel have great valuations right now. Let's take a quick look at the revenue breakdown of Autodesk. So Autodesk right now hits 4 markets. If you guys don't know, it creates software, and this software is used to model items, to model products. So they hit 4 markets. The biggest market for them is the AEC, and this is architects, engineering, and construction segment. So engineers, constructions use their products, and that makes up $397 million of total revenue. The second segment seems to be AutoCAD and AutoCAD LT, and that one's up 18%. AEC, the architect, engineering, and construction, is up 19% compared to the same time last year. Next, they have manufacturing. This is 186 million, and this is up 6%. And then they have media and entertainment, and this is 59 million, and it's up 4%. We can see their segments are pretty much in 2 major ones, which are like I mentioned, the architect, engineer, construction, and the AutoCAD. Me as an engineer, I see so many of my peers and so many of people I went to school with continue to use this in their jobs. So it's definitely a strong leader. It's definitely a leader in this market. If we take a look at Autodesk grow, they are expected to grow 14% annually on average for the next 3 years. So this is definitely, it's growing a little bit faster than Microsoft, but not as fast as Tencent. This company is increasing its revenues as the years progress and has just become profitable. In 2019 was the first year Autodesk became profitable. And this is amazing because this is more of a subscription-based, a subscription as a service, software as a service type company, where it's more of subscription based and one pays annually. And we can see earnings are now starting to pick up. It is profitable, and as revenues continues to grow, that earning is going to continue to grow. If we take a look at Autodesk's balance sheet, they have about $1.5 billion in cash and about $1.6 billion in debt. So they almost have a 1-to-1 ratio, which is, again, a pretty strong balance sheet. Not the best, but since they are profitable, I do believe it's okay for them to have a little leverage, and they don't have much leverage. It's almost a 1-to-1 ratio. So what are some reasons I like about Autodesk? Autodesk, I think, is one that is a market leader. Like I mentioned, a lot of my peers, I am an engineer, that's my main career, and I see a lot of my peers use it. I see a lot of growth coming in, especially now with this working from home environment. Most companies will probably need more licenses so more people can work on it from home. And also a lot of just contractors that want to create their own business use AutoCAD for the progress. Media entertainment, which is their smallest segment, I believe as as the world continues. Creativity is one that I believe is such, and content creation is one that I believe is such an undervalued investment as well. And I do believe we're going to continue to see higher growth on that media and entertainment segment. Some of my risk about Autodesk is, first, right now, this working from home might have pushed the valuations a little bit higher, and we might be seeing a lot more growth because of it. So there might be some time where we might see a pullback. Again, that doesn't mean it might happen. None of these risks means that they are going to happen, but it's just things to keep an eye off. I do believe that might be my only risk that I see with Autodesk. Like I mentioned, they are a huge leader in this market, and I personally don't see many other as a person that's in this field, I don't see many other software companies or competitors that I should really watch out for Autodesk. Another risk is they just recently became profitable. So in the past, they have been unprofitable. Right now, analysts expect it to continue to be positive earnings and grow, but just we don't have too much history on that growth as of now. And for me, Autodesk right now, I think is percentage-wise is as a tier 3 stock, but I do want it to grow as a tier 2 stock. So I am continuing to add as the time progresses and I continue to get money into the market. The fourth stock I'm going to take a look at is Mercado Libre. This is ticker MELY to all my podcast listeners. Has a market cap of about $53.65 billion. Year to date, it has returned about 76% to investors. And from its peak, it's actually down about 10% from that correction we saw in September. So Mercado Libre, let me try to zoom in, has pretty much 3 segments it focuses on. And they're actually broken down in the revenues, actually broken down into 2. They are in the e-commerce segment, and they're pretty much in Latin America. They also in the shipping services, which kind of that revenue kind of goes together with the e-commerce, but they're 2 individual business segments. The third is fintech, where they have they have e-wallets and other types of fintech services, very similar to like Square and PayPal. So if we take a look at their revenue breakdown, this most recent quarter, they made $878 million of American dollars, about 582. So over 60%, I want to say, comes from their e-commerce market, which includes the shipping and the e-commerce and all the other commerce that they do. They're mainly in their biggest countries right now are Argentina, Brazil, and Mexico. The next comes from their fintech net revenues, and that makes up about $300 million out of that 800 and something million dollars. So about the other 30 to high 40% of the revenue comes from there. If we take a look at MELY's revenue growth, they are expected to grow 31.2% annually on average for the next 3 years. So this is definitely a true growth stocks. It is growing a lot faster than any of the other ones we have seen right now. One thing is MELY has been barely profitable. But it is profitable minus this year due to COVID. They have had a lot of expenses that have kind of pushed them into the red, a little bit red, but we can see their revenues are expected to grow and their earnings are also expected to grow as the years progress. They right now have about $2.8 billion of cash and short-term investments and about $1.2 billion in debt. So this is actually a very, very strong balance sheet. They have a lot more cash than they do debt. So what do I like about MELY? MELY right now, it's in a very growth state. It's in countries that can continue to see that strong growth in Mexico, in Brazil, and Argentina, and they're pushing into other Latin America countries. We're also seeing them having a very strong cash and short-term investments. I am very, very bullish in the markets they're in. E-commerce and fintechs are 2 markets that I'm also very bullish on right now. What are some of the risks I see with MELY? The first thing is this is a very competitive market. I know Sea right now is moving to Brazil. And again, there's other competitors that Mercado Libre might see in their country. So that's one of the risks. The other thing is the international risk. These are more Latin America countries. A lot more known corruption compared to investing in United States company. I'm not saying United States is not corrupted, but it does seem like we see a lot more corruption in these countries, for example, Brazil or some of Central America. So that's another risk. Another risk that I can see is Melly right now. The e-commerce segment is one that's very low in margins, and we see that with Amazon, we see that with Sea, we see that with Alibaba. Those profits from e-commerce or commerce are usually very, very low. Very low. So we can see even though they are profitable, it's not a huge, they don't have strong margins. So that's another thing that investors should keep an eye out when investing in this. Like I said, for me, e-commerce and fintech, their strong balance sheet and their strong growth expectations are ones that are driving me to buy Melly. Melly right now, I do believe it's a tier 3 stock. It's one that has the potential of being a tier 2, depending on how much more exposure I need in the e-commerce and fintech market. But I do have I have other companies within that segment that kind of help me increase that exposure. But Melly, I could end up seeing it being a tier 2 in the future. Definitely never a tier 1 though. The next two companies that I'm going to take a look at are ones that I actually sold a few positions to buy these. The first four I mentioned are ones that I put weekly allowance into my investment portfolio and I buy from there. So those were there. These two are ones that I wanted to buy and I ended up just reducing exposure on certain positions, just either because I believe my exposure was a little too high, my initial exposure was a little too high, or just because I believe that these two probably could return a little better results with some of that money. So the first one I did was JD, and this is stock number 5, ticker JD. To all my podcast listeners, JD.com is the company. It's in the past year to date, it has returned about 101% to investors. So very strong results. Right now it has $114 billion in market cap. So JD, if you guys don't know, is the number 2 e-commerce leader in China. Their net segment is broken down into two revenues. It's first their retail, JD Retail. This makes up, I want to say, over 95% of the total revenue. It's $46 billion last $46 billion last quarter. Then they have about $2.2 billion in new business. So about 5% of the overall, maybe even less, but roughly 5% of the revenue comes from this new business segment. These new business segments include things like JD Health, JD Logistics, and JD Health is something that they're trying to go to more of like a Teladoc style, which I think is pretty impressive. They also have a lot of investings in other small companies like Data Group, which is pretty much like a local on-demand delivery system that they own a huge stake in. So we can see they are a bit diversified, even though a huge portion of their revenue comes from JD Retail. If we take a look at the growth expectations for JD.com, right now they're expected to grow 15.8% annually on average for the next 3 years for their revenue. They're also expected to grow their earnings. JD right now has just become profitable in the most recent years, and as their revenue continues to grow, they do expect to grow that earnings as well. If we take a look at their balance sheet, they right now have about 120 Chinese yuan billion Chinese yuans in cash and short-term investments, and they only have about 26 billion in debt. So they have a lot more cash than debt. So that's a really strong balance sheets. Now let me take a look at what I like about the business. So JD stock, I do like is they are the number 2 leader in China right now, a huge population country in an e-commerce market, one that I'm very bullish. They're also very focused on high tech, on improving their technology, and all these companies that I've done. If you guys want a very in-detail analysis on them, check my channel and just look for that ticker. I have done full analysis on all these companies where you can really see understanding what they do. But JD is one that I feel is very a strong innovative company, and with that strong balance sheet and that strong growth, it's one that I can gladly have in my portfolio. What are some of the risks with JD? The first thing, like I mentioned with Melly, this segment is one that has very low margins. So even though it is profitable, their profitability margins are very low. Another thing is, again, this is a Chinese international company, so we have that international risk. We also have that added Chinese tension China United States tension right now that is growing. Another risk is right now based on the COVID situations. A lot of these e-commerce companies have grown dramatically in valuation. So I do believe these will be a lot volatile in the upcoming months. So that's another risk to understand. But again, JD at the moment, even with all those risks, is one I'm willing to continue willing to dollar cost average into my portfolio and add more. So JD right now is definitely a tier three stock in my portfolio, but it's one that I can see actually going into tier 2. For me, it will never be a tier 1. The final stock I bought into is ticker FEAC, and this is actually a SPAC company, a special purposely acquisition company. Right now, ticker is FEAC, is sitting at $12.39. Year to date, it has returned 25.15%, but that's because this is a SPAC company, and once that news came out, it has given strong returns due to the speculation of the company they're going to purchase. So they actually did announce what company they are trying to merge or purchase, and this is the company Skillz. Skillz right now is esports, pretty much a competition for mobile games. So what they pretty much do is they have certain games that you can play and you can join. You can join tournaments, live leagues. You can climb the leaderboards. You can win prizes, and it's just an overall competitive, a place where you can be competitive with certain games. Right now, the games that they have are very casual games like solitaire, dominoes, 2-minute football, baseball, battle ball. Nothing crazy right now. What I do like right now about Skillz, let's take a look at this returns in growth. From 2017 to 2019, Skillz achieved a revenue compound annual growth rate of over 167%. This is a true growth stock. In 2020, Skillz expects to achieve a $225 million of revenue, which is almost over 100% growth compared to 2019. This company is just growing like crazy. If we take a look at Skillz balance sheets, they have one thing though. Skillz right now, it's not profitable. It's definitely one that's losing money at the moment as it continues to grow that revenue. Cash and cash equivalents though is about $69 million for Skillz, and they only have total liabilities, all the debt that they own. They have no long-term debts and they have no short-term debt, which is pretty good. But they do have total liabilities of about $30 million. So this company actually has enough cash and cash equivalents to pretty much pay off its total liabilities, everything from debt to leases to everything else. So that to me is a very, very strong company. So what are some things that I like about Skillz? Skillz, my major thing, huge grower, a very huge grower in the market that I believe is very undervalued. Even though right now it's not in very popular games, they are trying to grow into companies that into games. They're trying to add more popular games. They're trying to move into first-person shooters, into racing games. If they do grow into those types of games or start adding them into their tournaments, I think that would be a huge turning point for Skillz. And that to me would be something I genuinely feel it's gonna go. And they talk about it in their growth strategy that's where they want to go. Other things I like is their strong balance sheet that they have. And what are some things that I don't like? What are some of risk investing in this company? The first thing is this is a special acquisition play. So there's always the possibility that the acquisition does not take place. So there is a chance of losing some of that money. Another risk is they are currently not profitable. Even though they have strong balance sheets, they're still not profitable. So that's another thing to keep in mind of, even though they have plenty of cash right now at the moment. And by going through this public merger, they are going to acquire obviously more cash and cash equivalents to be able to have, to even have a stronger balance sheet than they already have right now. Other risk is, yes, they are expected to grow into certain games, but right now the games that they're in, I don't believe it is anything to really go home and tell your parents about, right? The games there are kind of weak, if I may say so. But like I said, in the future they get into the better games, that would be a huge turning point. To me, the biggest risk is that it is a SPAC play right now, so there's always a reason that this acquisition might not happen. But with the acquisition, they are expected to pay about 3 point something billion dollars. Right now, the market cap is 1.07 billion dollars. So there is some strong growth that could happen in this play. Right now, Skillz FEAC is only one that would always be a tier 3 stock. I can't see this being a tier 2 stock unless we see that growth into different games. If we start seeing some really big names into the first person shooters in some of those games, this is one that can eventually end up going into a tier 2 stock in my portfolio. So that's it for today's video. I hope you guys enjoy it. There was a lot of information. Like always, if you guys enjoy it, make sure to hit the thumbs up, make sure to subscribe, and let me know in the comments which one of these did you guys like, if any. And did you guys like that new method that I did where I talked about why I like the company and some of the risk I see? This is something I definitely want to try right now, and I believe it's gonna help out my overall thought process of each business. So take care, guys. Have a good night, and see you next time.